Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today we're going to be talking about an option strategy that some are really drawn to because of its flexibility, whether we're a highly confident, aggressive trader or maybe a little bit more conservative by nature. We're going to be talking about a strategy known as a long call vertical spread. We're going to be weighing pursuing high reward potential versus high probability of success. A lot of things to consider. It should be a really good discussion. Before we can get to any of that, though, let me first of all say hello to everybody who's out there on YouTube already chatting in. Great to see everybody. Hello there, Richard and Joe. Hello, Lyle and Jorge and Jay Richardson and Chuck. And it looks like we have a big Harley Davidson fan out there, so great to have everybody on board. If you're one of those who've been here in our webcasts in the past, you're joining us week after week, we definitely appreciate your attendance and your contributions to these discussions. If you're here for the very first time, and there are a couple out there, those screen names that I didn't entirely recognize, welcome to you. We'll try to go to a pace that everybody can follow, but also want to let those know that are watching the recording after the live stream, enjoy the show, but be aware that you're invited to join us in the live stream if you'd like to be here. This is a Tuesday webcast series. We kick things off promptly at noon Eastern time. We'd love to have you in our live stream audience. And also as a special treat for our live stream audience, we have John McNichol. He's going to be hanging out in the chats. He's going to be addressing any questions that I can't get to. John is an absolutely fabulous coach. Thanks for being there, John. And John and I would like to issue an invitation to all of you to follow us on X. If you have an account on X, you should be following your favorite presenters there. You can follow John there at John McNichol CS. You can follow me there at Cameron May CS, but it is the very best place to connect with me in between these live streams. But let's get right into this discussion of long vertical spreads and selecting between high probability of success versus high reward potential. But of course, as we do this, we have to consider the risks associated with trading and investing. These disclosures are important, so bear them in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including a loss of principal. Okay, Ricebird, you noticing I got some sun over the weekend? Yep. I've enjoyed it, but yeah, I'm a little bit, maybe a little redder than typical. But let's set the agenda for today's discussion. A few things that I want to talk about. I'm going to spend just a minute reviewing the S&P 500, just sort of as a contextual backdrop for this discussion of a bullish strategy, which a long call spread is. But I want to leave the bulk of the time for an examination of two very different approaches to the long call vertical spread strategy. One is going to be more, we might consider it to be more conservative, but a higher probability way to trade spreads versus a higher reward way to trade spreads. What are the pros and the cons of each? How might they be structured? And we're going to make sure that we plan and place an example trade by the time we're done. So there we go. That's what we're going to be doing. Janelle, thank you for saying we missed you, Cam. Yep. It's great to be appreciated. Glad to be back at it. But let's go right to the Thinkorswim desktop trading software platform. And here's the S&P 500. So we're going to be talking about a bullish strategy. Let's put ourselves in the shoes of that would-be bullish options trader and maybe set a stage for why they might select a bullish strategy in today's conditions. Let's say they're among those that call themselves technicians, those that use charts in the planning and placing of trades. And if we look at the S&P 500, there's something that might be interesting to some technicians that's happened recently. Obviously, the S&P has been in very strong recovery mode since we hit these lows on April 7th. We've started to make what we'd call higher highs and higher lows. Are starting to cycle those levels higher. But recently, about a week ago, we hit a peak, a short-term peak here on the 19th, pulled back to a low around that 5,800 level. And that 5,800 level to some technicians might be carrying some additional significance, at least this year. What you'll notice is as we look back over the last couple of months, that low around that 5,800 is pairing up pretty nicely with a previous high, a former price ceiling or resistance, lining up with a potential new price floor or support. And this isn't the first instance of this. You can see that this was actually a pretty good price floor for a stretch of months here. And it was also ceiling here, ceiling there, a floor through this maybe about 3-week period. So let's say that our technical trader sees this bullish action starting on April 19th as just really accelerating recently off this price floor. Maybe their expectation is that the S&P 500 is comparatively less likely to go back down below 5,800. And they think, as they're planning a new trade, and let's just say that we're planning a trade out here for that June 20th expiration. That's the third Friday expiration for June. Those third Friday options are the traditional expirations, and they still tend to have the greatest volume. They tend to have the greatest liquidity. They tend to have the narrowest spreads. They can offer a number of potential advantages to the trader. So let's just say that we're looking at maybe planning a trade for June 20th. And our trader's expectation is that this bounce that we've seen off the 5,800, they just think it's likely to go higher. All right? So maybe we'll draw that in. Let's switch up our drawing tool to the trend line tool just to visualize this. They think that prices are likely to go higher. Okay, so that is the backdrop using the broad market index. Obviously, the S&P 500 isn't the only one that a trader might use, but it's going to serve our purposes today. And let's go look at an example stock. So I'm going to be using, for today's example, Walmart. Now, I talk about this again and again as I move over to our example stock. What are some of the attributes of a stock that a trader might consider when planning an option trade? Well, not every trader thinks the same way, but for a number of traders, some primary considerations might be liquidity, price, and the chart. Liquidity, if we have an illiquid stock, it tends to have illiquid options, and that spread between the bid and the ask price that I mentioned a little bit earlier really starts to widen in many cases, and that can make the options a little bit more difficult to trade and trade profitably. So we already know that it can be tough enough, even if we understand the strategies, without inserting obstacles in our path. So this is one obstacle that some might prefer not to try to tackle, is a liquidity issue. So they might look for stocks that are highly liquid. They also might look at the price per share. Higher price stocks can have some advantages to the options trader. They give more choices as far as strike prices are concerned in most scenarios, but they also come with higher potential obligations on a per share basis. We're talking about the contracts that we're getting into. When we're selling options, even when we're buying options, it can get a little bit pricier. So for some, that can be a consideration. So here's Walmart, one of the most liquid companies out there in the world. Number two is the price is right around $100. It's a little bit below that at the moment, but a lot of stocks are up there in the multiple hundreds of dollars per share. And when we're trading 100 share contracts, yeah, that can come with a pretty big price tag pretty quickly. Now, that's not to say that it doesn't fit any particular investor's portfolio, but it's a consideration for some. Right? Now, the final thing is what's going on with the chart. What are you guys seeing happening with the chart? Well, Walmart has been working its way higher over the last 12 months. It had a rough patch right here, just like pretty much everybody else, from the middle of February right to those April rally points. But since then, it's been making its way higher. And then as we look over the last few weeks, what might we call this? When a stock that's already been going up has a strong rally followed by a kind of a settling period and then an advance. This, to a technical trader, might be known as a bull flag pattern. Run up, a pullback, and then potentially we're starting into a new run up again. So let's just say that our technically oriented trader here, already bullish on the stocks. Yeah, Lyle spotted that bull flag. Yep. Let's say that our trader who's already bullish on the stock market, at least as represented by the S&P 500, now sees bullishness on their individual stock, and maybe that sets the stage for planning a bullish options trade on that stock. So for today, the bullish options trade that the strategy that we're going to demonstrate is known as a bull call spread. So let me just ask a question. Got about 150 people watching right now. How many of you are familiar? Just yes or no. There's no shame or embarrassment in not being familiar with the strategy. Everybody had to learn it at some point. But are you familiar with a bull call spread? John's saying, is there consolidation right here? John, could be, right? Not every trader is going to see this chart in the same way. Now, with this strategy, depending on how it's structured, even consolidation can work out just fine. Okay, Ari says yes, and Scott says yep, and we're getting Janelle and Matt, no, and free to choose to, no. Okay, so I'll explain this strategy. As I mentioned, I try to go at a pace that everybody can follow, but let's just envision that our trader thinks that this stock is more likely to go up than not. We don't know how far. Maybe they use this flag pattern. If we zoom in, could we get a little bit fancier here? With a flag pattern, some traders will use the height of the flag. So this one went from about $92 up to about $99. That's about $7 up. And they'll use that as projection for how far the stock might be expected to go by that trader as it starts to move again. So if we started to move again around 96.5, maybe it's going to go up to maybe 103, 104, something like that, about another $7 higher. That might be the technical expectation. Obviously, nobody has perfect insight into where any stock is going, right? Chuck says, is this based on a 10-day moving average? This pattern is not, Chuck, specifically. Some traders might use a 10-day moving average in their trading, but I didn't really recruit this for the structuring of this trade. Nope. Okay, yes, BLR says, is this a long call vertical? Exactly. Yep. Yeah, we're going to be doing, it's known as a long call vertical, a long call spread. There are definitely different names that we can apply to this. It's also one in the generic group of what we call debit spreads. But let's go build one of these trades. And what we're going to do is we're going to structure the first one to have a high probability of success. The trade-off for that, though, is it's going to come with a comparatively lower reward potential. That's the way that these strategies are built. What I would love for somebody, you can chat in and let me know, if you know a high probability, give me something that has a 90% chance of success and $3 of reward for every dollar of risk, I'll love you forever. But seriously, that's sort of the trade-off with vertical spreads. So we're going to structure the first one to have a high probability of success. We're going to structure the second one to offer higher reward potential than the first, but it's going to come with its lower probability. But maybe there are steps that a trader might believe they can take to hopefully improve those odds. Okay? But let's zoom back out on our chart now that we understand where we think our stock is headed. Let's go to our trade tab and start to build this trade. So it's called a long call vertical. Long in trading terms just means we're buying something to start a trade. Short means we'd be selling something to start a trade. So this is a long call spread. It's known as a call spread because we're going to be using call options to build it. And it's known as a spread because we're going to choose one spread at one strike, another spread at another strike. It's going to be separated by price. So there's a spread or a distinction between the two in price. So our first one is going to be, we'll just call this trade A. Let's call it example trade A, because these are always just for example purposes. Example trade A is going to be a high, I'm going to abbreviate it to prob spread. Okay? How do we make, those of you who said that you are familiar with the long call spread strategy, how do we make it high probability? I think a lot of you know exactly what to say. Use the acronym. What do we do? We're going to go in the money, ITM, with this one. In the money simply means whatever the stock price is, we're going to be using calls that are lower in price than that. Okay? So in today's example, with our stock up here, it's at 97.5, almost exactly 97.5. Let's say we looked at, well, possibly the 97, possibly the 96. I wonder. Let's go for the 96. Let's see, if we bought the 90, pardon me, if we traded the 96 and the 94, let's do that. So here's how this is structured. First, we need to buy something. This is a long spread. So it's built on buying. So in this example, let's say we buy the 20th of June, $94 call, and that looks like that's trading. If we look at that $94 call between $455 and $465, let's say we're able to buy that for $460. So that's one side of our spread. The other side, we're going to sell. So we're going to sell same, so we're going to stay with the same stock, we're going to stay with the same expiration, we're going to stay with the same number of contracts, just a different strike price. So we're going to sell the 20th of June, let's say the $96 call. And that looks like that's trading for between 310 and 320. Let's call it 315. All right. Yeah, Ari was ahead of me on this when I said, how do we make this high probability? We go in the money, right? Yeah, when we have prices that are below the current price, what that means is, for example, let's take this 94 and let's explore what we're getting ourselves into. So we have two call options, and one thing that I would encourage any new options trader to do is don't panic when you're trying to figure out these fancy what we call a multi-leg strategy, where we have different options that we're combining into one strategy. Instead, just look at the individual options. So for example, we'll just look at this call that we're buying first. Okay, so we're buying the 20th of June, $94 call. What does that mean? Well, we're paying $460. These are standard contracts for 100 shares. So we're paying $460. And for that investment, we will have the right through the 20th of June, the right to buy 100 shares of Walmart for $94 per share. That's the deal we're getting. So Walmart's worth more than $94, so we would say this is in the money. It has some intrinsic or some inherent value. Now, at the same time, we're going to sell the $96 call. So let's forget about the 94 and talk about just what the 96. Dynamite says, do you have an amount of capital you'd recommend starting with? I don't make recommendations, Dynamite, aside from saying it's generally a good idea to practice with no money, maybe before moving on to real money when we're exploring a new strategy. Now, some people learn by doing with real money, it makes them more intense. I can get that, but that's up to the trader to decide. All right, but let's look at just this call that we're selling. So in this case, we are collecting all of this conceptually if and until the order fills, right? But somebody's paying us $315, and in exchange, through the 20th of June, someone has the right to buy 100 shares of stock from us for $96. So now let's put those two together. Spent $460, received $315. What's the net cost of this trade? This is also the theoretical maximum loss of this trade. 460 minus 315, by my math, is $1.45, the cost on this trade. So it's costing us $1.45 or $145 for the right to be able to buy shares at 94, but also the potential obligation to have to sell those shares for 96. If we buy at 94 and sell at 96, isn't that a $2 profit if this were a free trade? Yeah, it's not a free trade. It cost us $1.45 to set it up. So $2, if this works out, we make $2 out of a $145 investment. What does that leave us with as a profit, just setting commissions aside? Our theoretical max gain is that $2 minus the cost of the trade leaves us with 55 cents, or in other words, $55. So $145 being spent to get into this trade, with $55 of potential reward above that cost. Does that make sense? So Yes, now I'm sure some of you just went, wait a second, this is my first time hearing about this. Are you telling me, because your screen is telling me, I can lose 145 bucks on this trade and I can only make $55 on this trade? Yep, that's what I'm telling you. Those are the theoretical maximum parameters in either direction for this trade. This is not a high reward scenario if we define high reward as being at least $1 of reward, or maybe even more than $1 of reward for every dollar at risk. It doesn't meet that criteria. So why would anybody do this? It's because of its high probability. Now, this is a trade that I can say mathematically it's probably going to work out. What are the probabilities on this trade? Well, there's a hint right here on the screen. If you haven't heard of this strategy before, I'll just tell you, the best scenario for it to have the best shot at working out is if the stock is above $96 on the 20th of June. That's where we'd like it to be. If it helps, let me put this on this chart here. Let me get rid of this drawing. I'm going to zoom in a little bit. So here's where the stock is right now. And I'm going to draw in one line at $96 from today and carry it right on out to that expiration that we've selected. There we go. And then let's draw another one down at $94. Let's start that from today and carry that out to expiration. So these represent the two contracts that we're getting into, 96 and 94. And where we would really like to be is up here somewhere as we get to the 20th of June. Now, if this is where we'd like to be, notice where we are already. This stock actually doesn't need to do anything to be in the right position at expiration. If we just drifted sideways from today all the way to expiration, we're in good position. If the stock goes up, great. That works too. If the stock goes down, that also works as long as we don't go down below 96. So here's why being above 96 is where we would like to be. Well, and by the way, before I get into the why, there's actually a precise probability. Precision is tough when we're giving probabilities, right? But let me go back to the trade here. And if we look at the 96, one function of delta, there are several potential functions. Really, delta is commonly used to see how much an option might gain or lose as the stock price moves up or down $1. But also, if we look at this delta of 64 for our $96 option, some traders will look at that and they'll just say, okay, look, so we have about a 64% chance that this trade's going to work out. Because delta gives us an approximate likelihood that our option will be in the money at expiration. Another way to say that is there's about a 64% chance that the stock will be above $96 at expiration. So let's go back to the why this works out. Okay? Whether we're up at 99, we go sideways and we're still at 97.5, we go down and we're at 96 or 96.5. Let's just say, let's sort of split the difference here. Let's say our stock does just go sideways till expiration. We're still at 97.5 at expiration. What happens with these two contracts at that point? Well, we know we have the right to buy shares at $94. Those shares are worth 97.5. When I say we're putting ourselves in the shoes of this hypothetical trader, right? But if our trader has the right to buy shares at 94 that are worth 97.5, are they going to do it? Of course they're going to do it. They can decide not to if they don't want to. They can call their broker and say, do not exercise. If they don't make that phone call, the broker is going to exercise that on their behalf. Yeah, the shares would be purchased for less than they're worth. That's generally a good thing. But at the same time, someone else has the right to buy those same shares from us for $96. So if we buy the shares at 94 because they're worth 97.5, someone else has the right to buy the shares from us at 96, they're going to do it as well. The shares are worth 97.5. So we buy for 94, they buy from us for 96, that's a $2 profit. for which we paid $1.45 to set the whole thing up, and we would then have our realized 55-cent gain per share on 100 shares. That's $55. Lawrence says, I'm hoping Walmart goes above 100. Well, Lawrence, this trader would be totally fine with that as well, because that just makes that outcome even more likely. So that's the fun part. What's the not so fun part? Well, if our stock collapses in value, if it goes down here, let's say it goes down to 92, and we have the right to buy shares for 94, are we going to do it? Probably not. Nope. We don't want the shares. They're only worth 92 bucks. So we lose our 460. The other trader has the right to buy those same shares for 96. They can do it? Probably not. They don't want a 92. They don't want to pay 96 bucks for a $92 stock. So they lose their 315 and we keep it. The net between those two is that we just lost our 145 if the shares fall down, and especially if we hit that expiration below our spread. So this is our no-fly zone. We don't want to go here. So let's put a box there. Let's make that one red. Okay, it's where we don't want to go. It's actually, I don't like that color of red. Sorry, I'm going to nitpick this a little bit. Let's make it this color. It's a little bit easier on the eyes. There we go. All right, now there is one other outcome. If we decide to just put this trade on and let it go to expiration, we might be above 96, we might be below 94, we could be in between, in which case we might wind up buying the shares for 94, and the other trader walks, and we wind up owning the shares. That might not be our intended outcome. Then we have to just decide what to do with the shares, maybe on Monday after we wind up buying them. So Brown Buffalo says, is this a defined loss scenario? It is, Brown Buffalo, unless, so we say a theoretical maximum gain and a theoretical maximum loss, but could those things change if we wind up owning the shares and then the shares do something unexpected? They go shooting up and we make more money, or they drop down and we lose more money than expected. Yep. So that's, just be aware, that's a danger. Okay? But just so for that reason, what some traders might do is as they get closer to expiration, particularly if the trade is going down below 96, they might decide, let's wrap this up before I wind up, getting the shares. There's one thing that we should address is this thing known as early assignment, which sounds spooky when you first hear about it. What that means is that this trader who has the right to buy the shares from us for 96, they do it before we expected them to. Oh no, actually, that is generally the preferred outcome in this sort of a trade. Because if they wind up buying the shares at 96, what could we do at any moment? We could buy the shares at 94. Great. Buy the shares at 94. They already bought it from us for 96. That's our maximum gain scenario. So early assignment here, I'm going to throw that up in sort of, it is a risk insofar as a trader sees accomplishing their maximum gain as a risk, and accomplishing that maximum gain early. Okay, so that is our high probability spread. It has a lower potential reward, it has a higher potential risk, but is there a stronger likelihood of success or failure? Well, we've already determined there's a 64% probability of success. What do you think the probability of failure is? We can go back to our trade tab, look at the 94 delta, and know there's not a 75% probability of failure. There is a 25% probability of failure. What this 75 is telling us is there's approximately 75% chance the stock's going to be above 94, and we don't have maximum loss. So there's about a 25% chance of this happening. There's about a 64% chance of that happening. So 25%, let's be explicit, max loss. 64% chance of max gain. Add those together, 89% chance of one or the other happening. There's an 11% chance that we wind up in the middle somewhere. Not entirely at maximum gain, not entirely at maximum loss. And if we hit expiration in that scenario, we might wind up owning the shares, and then we deal with the, we either enjoy the gains of those shares subsequently or suffer the losses of those shares subsequently. So that is our high probability spread. And you can see why some traders might be drawn to this. Hey, so 55 cents, I know that doesn't sound like a lot. If I got 2 quarters and a nickel in my pocket, it doesn't sound like a lot. It's actually $55 on one contract, for which I only had to tie up $145. So if I make 55 bucks with a high probability of success on a $145 investment, what return is that for our, how many days of work? 24 days of work. 55 divided by 145 means this thing has a 38% reward potential in 24 days. Is that low reward? No, but it's lower than what we're going to discuss. And it is lower than the risk. Yeah. All right, so let's grab all this stuff. Let's copy that and let's paste it down here. And we're going to discuss a high reward spread. I don't need to make those caps. And let's change this to trade B. And we're going to change the rest of the features of this trade. So we're going to stick with the 20th of June to make it a fair comparison. But we need to know our maximum gain, our maximum loss. Got a little hiccup there. Sorry about that. There we go. Actually, let me get rid of this. And there we go. All right. So let's structure our high reward spread. So tell me, if we had to go in the money to create a high probability trade, where do you think we go to create a high reward potential trade? Yep, we're going to go out of the money. So that just means going above the current price of the stock. And let's just go back and revisit the thought process. Actually, I'm going to right click here. How far do I want to go with this? Yeah, that's okay. Let's just right click and let's clear the whole custom set. Now I am going to redraw my bull flag. So there was that $7-ish move right there. And then we had the flag pulling back right here. And that looks like we're popping out from that. So what some traders might do is they'll look at this $7 distance that we traveled up, and if we start to travel up again, maybe we're going to do that again. Definitely not a guarantee. But let's duplicate, right click and duplicate on this flagpole. I'm going to tack it right on there, the breakout point at about 96.5. And what that might do for us is project, ooh, could we get a move up close to that 104 that we discussed earlier? Let's say that we have trader B and they're considering this high reward spread. They're looking at trader A and saying, you're a sucker. You're leaving profit potential on the table, because if this runs up, we might be able to make a heck of a lot more than 38%. We might be able to make a heck of a lot more than $55 on a 145 investment. So here's how they might structure their trade. They may go out of the money. And let's see, if we have the potential to go up, let's say maybe we only need to get up to 102. I'm going to go to the trade tab. Let's go down to 102 and then back off by $2 so that we're sticking with that $2 spread. Now, I'm not saying that there's anything magical in a $2 spread. It's just what I'm using as a sort of an apples to apples comparison for today's discussion. There can be pros and cons to going with wider or even narrower spreads than this. But let's go with a $2 wide spread. And we're, instead of buying in the money and then selling in the money, let's say we buy the 20th of June 100 call. That looks like that's trading between 104 and 108. Let's just round that off and call it 105. And let's say we sell the 102 call, and that looks like that's trading between 52 and 56. Let's say, this is going to be a little bit generous. You'll have to forgive me for this. Let's say we're able to sell this for 55 cents. Okay? But there we go. So we're spending 105, but collecting 55 cents to set up another $2 trade. So instead of costing us 145, how much is this one costing us? Spending 105, collecting 155. That's only costing us 50 cents. So if we're spending 50 cents to set up another trade that might turn itself into $2, what does that leave us as a maximum gain? It's still a $2 trade. There's still $2 difference between our two calls. It's $2 minus that 50 cents. That leaves us with a potential reward of $1.50. Wow. Now, some traders immediately might say, oh, this is way better. Why would I set up a trade where I can lose 3 times as much as I can make when I have the chance to set up a trade where I can make 3 times as much as I could lose? All right, let's examine our trade, because these are real numbers. I mean, I've had some approximations here, but these are actual numbers that we just pulled off the markets right now. If we spend $1.05, that's $105. What does it give to the trader? It gives them the right to buy shares for $100 a share. Those shares aren't even worth $100 yet. So this stock needs to do something. It needs to go up. Okay? But if it does, we still have the right to buy shares at $100 no matter how high they go. Now, at the same time, someone has the right to buy those same shares from us for 102. So if we ultimately exercise our contract to buy at 100, and the other trader assigns their right to buy those shares at 102, that'd be a $2 profit, for which we only spent 50 cents to set the deal up. So after we settle that out, setting commissions aside, that's a $150 profit on a $50 expense. So that's superior in every way, right? Nope, it's not. What is the trade-off here for all of that juicy reward potential? Well, it's the risk that the whole thing might not work out. This is not a high probability trade. Look at our deltas. What is a mathematical probability that the stock is going to be above 102 at expiration? It's approximately 20%. We've gone from a high probability scenario. This is a low probability scenario. However, our trader might still be convinced, hey, I've gone to the treble, I looked at that chart, I found that bull flag. That flag says we're going to 103.5, and if we get there, I'm going to triple my money. I'm actually quadrupling it. Yeah, but this is a low probability scenario. So there's actually a high probability in here somewhere, and that is a high probability that we're just going to lose our investment. We are going to lose the $50 that we spent. Because for that, we just need to be below 100 at expiration, and look at where we are already right now. And from here, a stock can go up or a stock can go down. If it goes down, the scenario just gets worse. So in this case, the trader really needs a stock to do what they think it's going to do, in which case there's a handsome potential reward. If it doesn't do what the trader thought it was going to do, there is definite risk here. So let's draw this in. So here are our strikes. 100, right about here. 102 is right there. It looks so achievable, right? Yeah, we'll see. There's 102. If we got a move similar to this one, it moved up that far in 2 days. Now, it might pull up that far in another 2 or 3 or 4 days. It could pull back. Things could get choppy, but what we're looking for is for the stock to be above 102 as we approach expiration. But these are two very different trade scenarios. One is high probability. The other one, high reward potential, low probability of success. But if a trader can be good at this, then maybe they are amplifying their reward potential. But being good at this is tough to do, obviously. Now we need to get up above 102. So I'm not going to draw the green boxes in here, but just be aware, our green box would be up here, our red box would be down below here, and winding up in between these two strikes could put us in the same scenario where we wind up buying the stock. Nobody buys it from us, and we just own the shares and get the fun of ownership after that. I say fun in air quotes, because it could be fun if it goes higher, not so fun if it goes lower after that. Now, one other consideration for both of these is the break-even point on the trade. How do we calculate the break-even point on a vertical spread? We figure out how much the trade can make, you figure out where it needs to go to make that, and then you subtract that amount from if it doesn't get to where it needs to go. That's a good wordy way of not really explaining it. Anyway, so this is a bullish strategy. In this case, we'd like this trade to be above 96, in which case it can make 55 cents as a maximum theoretical gain. So if it's not above 96, then we must not be making 55 cents. And as a matter of fact, every penny that we come up short of 96 at expiration, we're surrendering 55 cents of our maximum gain. So here's the equation for our break even. $96. You take where we need the stock to be, so above 96, minus the 55 cents that we could make. That tells us that our break even on this first trade is at 95.45. Now, if I ever make a mistake in my math, because I can do that as I'm trying to explain the trade and type and all that at the same time, let me know. But yeah, our break even is 95.45. Actually, our stock here is at already $3 above that. That first trade has a high probability of at least breaking even. Second trade does not. So let's take this, figure out our break even here. In this case, we need to be above 102. Now we can make 150 bucks or $1.50 if we get above 102. That brings our break even to 150 cents. That is actually way up here. So with this trade, just to break even, the stock has some work to do. It's got to get up here. With this trade, our high probability trade, stock doesn't have to do anything. It can drift sideways, it can go up a bit, it can go down a bit, still breaking even as long as it doesn't go down below 95.45. There we go. So let's quickly place our trade. And this one, I'm going to go for the aggressive one. Here's a quick way to place one of these spreads. So our strikes are 2 strike increments apart. Let's go to spread single on our trade tab. I'm going to go to deep and wide, and I'm going to go to 1 month. They're both in the same month, but they're 2 strikes apart, and choose vertical. And let's go to that 100-102 pairing and click on the ask price, and that creates our buy order down here. Yeah, I thought I might be generous at 50 cents. Let's say we're willing to spend 55 cents. And from here, we could just choose how many contracts we're willing to risk. $55 of risk per contract. And click confirm and send. Now this one, I'm not actually going to place a trade, but I do want to show when placing a trade, it's a good idea to just check the trade parameters, buying the number of contracts we want, strike prices that we want, the call 55 cents limit. If it fills, that gives us a 55-cent loss potential, or $55 loss potential per contract, $145 reward potential, but we also have to build in those commissions, so it actually does dial up the cost a bit. There we go. Then we can send that order off. But that's it. Guys, we've actually accomplished what I set out to do today. I wanted to talk through weighing the pros and the cons of setting up a high probability trade versus a high reward scenario. And then it's up to the trader to learn how to structure this to suit their own preferences. We could have made the probabilities even higher if we wanted to. We could have actually structured the reward to be even greater if we're okay with lowering the probabilities even further. So that's where this strategy has its inherent flexibility, and that can be attractive to a lot of traders. Not a sales promotion for any specific strategy. We're just talking about trading long call spreads today. But I hope you enjoyed that discussion. This is what we do on Tuesdays. Hope you'll join me again next Tuesday. Now, I have other webcasts throughout the week. You're certainly invited to join me there. I also want to invite you to follow John and me on X. But if you haven't done this yet, make sure that, that you subscribe to our Trader Talks That's not what I wanted to do. Close that up. Anyway, Trader Talk's Schwab Coaching Webcast channel. You can click on the subscribe button right down in the lower right-hand corner. Doesn't cost anything. It literally only takes a second. But this is where we house our playlists of our already delivered webcast series. You can also join the live streams right there. But also make sure that you're following John and me on X. You can follow John there at John McNichol CS. You can find me there at Cameron May CS. It's the best place to connect with me in between these live streams. I can give you updates on things. We can talk about things like this possible support on the S&P 500. We'll see if that holds. But that was just a post that I made maybe an hour and a half ago, something like that. But everybody, thanks for giving me your time today. Definitely appreciate that. I want to thank everybody that's already given the thumbs up. We have about 165 people watching right now. 60 have already clicked that like button. That's always appreciated. Everybody, have a great day. I will see you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.